Yeah, that's quite interesting to hear from the Commerzbank CFO, because yes, and in this rotation towards a value, European banks have been one very important subsector that, is catching a lot of attention from global investors. We believe that the markets are, happy to believe in the ECB fallacy. And why do I say fallacy? Because we know that, there are many cracks in the wall in terms of European growth. It's going to be very difficult to be as hawkish as the Fed. But for now, as an investor, and I agree with the way the markets are reading the market now, right? The ECB turned the corner in terms of calling inflation just temporary. You remember Lagarde 3-4 months ago dismissing the high inflation now and saying that, look, it's 50% energy, so we shouldn't act on it. The ECB turned the corner. The ECB is sounding more hawkish, and we might get up to some revision up in deposit rates towards the end of the year, but we know that it's probably not going to be, a very high flight here. It's probably going to be low because there is strong and glaring cracks in the wall in terms of European growth. And once peripheral spreads get going, we are probably going to be a lot more concerned about peripheral Europe once again.
Lewis, can I also ask you about the geopolitics around the dollar and the ruble? Because given the sort of tensions we're witnessing between the two countries, it seems as though we haven't got a huge elevated risk around a ruble at this stage. We keep every other day we're talking about headlines of build-up of troops on the border with Ukraine. But we've had a little bit of movement versus dollar ruble, but not as much as one might anticipate. What do you make that out to be about? Is this just the risk that we may see a de-escalation here?
Well, I think that's, it's been very resilient. And this is one point we've been making to clients. And number one, it will continue to be volatile. We don't think this story is pretty much done and dusted. There are very strong points to be made in terms of the architecture of European security system, and that's what the Kremlin is trying to enforce a new view. And obviously, Ukraine is involved in Ukraine and NATO membership. These are all parts of the same theme, and this theme will continue to be negotiated. But we believe in diplomatic negotiation. We do believe that the markets are trying basically to bring down the risk of an immediate impact, even though we know that reports of troop withdrawal, these reports are still quite debatable. And we're just having a few headlines here coming from the US that, there's not much troop withdrawal taking place as yet. So it's going to be still volatile. But on ruble effects, the interesting thing that natural flows in ruble, they tend to be positive. Here we are in the high hydrocarbon market, high oil market, Brent above 90, natural gas. So it's still a market that suggests a strong current account surpluses in Russia. And let's not forget, Russia used to buy FX. They used to buy dollars as a derivative of the fiscal law, and they stopped the purchase of dollars about a month ago in order to support the currency. This is making natural flows in the ruble even more positive for the currency. So we think that, in the whole array, in the whole asset array of ruble risk, of Russia risk, credits, rates, bonds, and FX will continue to be the most resilient part of the puzzle here.